Tell us what's happening now in this hopefully waning days of the pandemic to the food delivery industry.
Yeah, it's a great place to start. So like looking at the overall food industry across restaurants and groceries, there's constantly been kind of this food away from home, food at home kind of paradigm. So in aggregate, it's about $1.7 trillion in spending. And what happened during the pandemic was as restaurants closed their doors, we saw about a 20% decrease away from restaurants and a real big boost to grocers as people stocked up on groceries. But simultaneously within that, we had a massive growth in both online e-commerce for restaurant delivery, for takeout and delivery. And we also had a huge boom to online grocery, which I think is probably the biggest amount of growth. So in restaurant food delivery, I believe we went from about, don't quote me exactly on this, but like something like it's like 7% food of total food sales going towards delivery to somewhere now about 10%. It's mostly takeout, and then when it comes to online grocery, went from like 2 to 3% to 10%.
Wow!
So that's the major jump. That's where Instacart really came in and saved the day for a lot of grocers. And now here we are. People are waking up and saying, we need to do this ourselves. Grocers need to become technology companies, which is a very big challenge. And that's why now you're seeing a lot of the 10 to 15 minute vertically integrated players eyeing this TAM of delivery of grocery, which is about $1.1 billion, $250 billion of which is going towards your traditional fuel convenience stores. And then the rest, the other $850 billion is, your grocery outlets. So, we went from 3% to 10%. And in the next 5 years, we're expected to go from 10% to 20%.
Wow.
So that's a steady, 2% growth every year for the next 5 years. And, yeah.
And so based on what you're saying there, it feels like, the grocery stores and the convenience stores are saying, you know what, partnering with, Instacart, DoorDash, Postmates, Uber Eats, might be fine, but you're saying some of them are just going to decide to do it for themselves and go it alone and maybe stop in the grocery space. Are you saying that Instacart is going to see their delivery service go down because Vons or whoever, Safeway, decides, you know what, this is our core business. If 1 out of 5 customers is going to take our services by delivery, why are we even having Instacart in the building? Why are we enabling their business? Why don't we just be fully integrated, which I believe is what Whole Foods chose to do, correct?
Well, yeah. I mean, they sold to Amazon, and Amazon is building a very compelling omni-channel offering now across in-store with Whole Foods as the high-end kind of banner and Amazon Fresh is kind of the middle market kind of Kroger banner. And then the online component, which is Amazon Fresh, right? And then for the other grocers, I don't think can even compete because they need a player like an Amazon to come in and completely revamp everything from their purchasing all the way down to the consumer experience and the logistics. So they've kind of cobbled together these solutions. And I believe that over the long term, the Albertsons and Krogers of the world will just buy their technology from the likes of Ocado, Instacart, etc., and use them as picks and shovels if those companies can offer those picks and shovels. But the real interesting thing is the rise of the vertically integrated grocer that's going to try to attack these guys at their knees. So, by offering faster delivery, obviously not the same 40,000 items of products that you would find in a traditional grocery store, but a much more curated set of grocery items, and pantry items for this category of instant needs, which we can get into. But
the strategy for these vertically integrated ones, are those like the Jokers and the Getters and the corner stores, which was obviously bought by Uber? This is this new category of lower number SKUs but quicker delivery time, correct?
Vertically integrated, yeah. And that's kind of the key here. It's that, a lot of the labor laws in this country and abroad do not support, sustainable delivery at high penetration volumes. And you see this with DoorDash is now betting heavier, more and more on DashMart, which is their vertically integrated solution. So they're actually making margin off the product. And I think you're going to see a lot more players enter the space because there's been proven models abroad with the likes of Getir, as you mentioned, or however you pronounce it, Getir, and Delivery Hero that have, really built billion-dollar businesses through dark kitchens and dark supermarkets, D-marts, dark stores that have basically transformed, vacant retail on Main Street or off of Main Street and transformed it into kind of a last mile infrastructure that house commonly ordered items from local bodegas or random, corner stores.
So what we're seeing is there was this model where Postmates or Instacart, I think were the ones who pioneered this, would send a Postmates. I don't know what they used to call them, but a Postmater. I don't know. They would call them your Postmates. It was like a personal shopper, basically. Or Instacart would send a personal shopper for you, a shopper, to a store that already existed in the world, buy your stuff, deliver it, charge you a markup. But if you're, Joker or I guess this new corner shop, the concept is that Uber's corner shop would inventory the items themselves, have the drivers there. It's one app. It's not two different parties involved in the delivery. It's just one party. And it's a lot more seamless. If you have a return, if you have an issue, and then it knocks 10 minutes off the average delivery time or something.
Yeah. I mean, you go from a traditional, I guess Instacart was offering 1 to 2 hour delivery. Now they're offering 30-minute delivery to kind of compete against these guys. Getir kind of pioneered the 10-minute model. We're splitting hairs at some point. It's like, really what this is about is a land grab for customers in certain markets. And the way to do that is to go plaster a bunch of billboards and say you're going to offer free delivery in the fastest amount of time. Gorillas is doing it in 10 minutes. Joker's doing it in 15 minutes. There's one that's even called 15-20, which in the name implies 15 to 20 minutes. Does it really matter? We can talk about that. I don't think it really does between 15 and 30, but it is a land grab right now.
Heads up, the days of the 60-40 portfolio might be over. 60% stocks, 40% bonds. Bank of America and Goldman Sachs both agree. Mounting pressures from inflation and the Fed's upcoming tapering deadline might slow down the economy and could cause trouble for stocks and bonds. I think we all know that. So diversifying is more important than ever. It's also important to look at alternative assets uncorrelated to the stock market, like contemporary art, according to our friends at Masterworks. Many savvy investors, you might know some, hold 10 to 30% of their net worth in art, and here's why. Well, according to Masterworks research, contemporary art appreciated 14% annually between 1990 and 2020. It's a pretty good 30-year run, if I do say so. Now, you can invest in blue-chip art without paying tens of millions of dollars. Masterworks makes investing in iconic art like trading stocks online. They securitize a multi-million-dollar painting, and then they sell shares to investors. I've done it. It's really easy. And they just raised $110 million Series A with a valuation north of $1 billion. Congratulations on becoming a unicorn. And guess what? Twist listeners get to skip the very long wait list to get on Masterworks. If you want to invest, just go to masterworks.io/twist to get priority access. That's masterworks.io/twist. And make sure you read the important disclosures at masterworks.io/disclaimer.